14 million Americans are collecting a check this month that 76% of their neighbors will never receive in their entire working lives. Not from an investment account, not from a lottery ticket, from something called a pension. And if you are one of them or you are lucky enough to still be earning one, everything you think you know about retirement planning is about to be turned upside down. Because right now, only 24% of working Americans have any access to a pension at all. That means if you have one, your retirement math does not work like everyone else's. It works backwards. While 76% of the country is trying to build one giant pile of savings and praying it lasts long enough, you already have something most people will never have in their lives. 2 guaranteed income streams instead of one. A pension and Social Security both showing up every single month for the rest of your life, no matter what the stock market does, no matter how long you live. That sounds like the retirement lottery ticket, right? Stop right there. Because that guarantee, the very thing that makes you the envy of everyone around you, is also the exact thing that can quietly hand a huge chunk of your retirement over to the IRS if you do not understand 4 specific rules. Rules the financial media almost never talks about, because most financial media is built for the 76% who do not have this problem to begin with. Here is the part that catches pension holders completely off guard. A pension is not taxed like an inheritance. It is not taxed like a Roth withdrawal. It is taxed as ordinary income, the exact same category your paycheck used to fall into. And ordinary income is the most aggressive, most heavily taxed category the IRS has. That means every single month, your pension check can be quietly pushing you toward higher tax brackets, toward taxing more of your Social Security benefit, and toward something called an IRMAA surcharge that can suddenly make your Medicare premium cost hundreds of dollars more per month. Nobody warns you about this when you retire. You get the pension paperwork, you sign it, you celebrate, and years later you open a letter from Medicare wondering why your premium just tripled. By the end of this video, you will understand exactly why that happens, and exactly what you can do to stop it before it happens to you. My name is David Marshall, and this is David Marshall Finance, the channel where we take the complicated, confusing side of money and break it down in plain English. No jargon, no sales pitch, just the truth about how your money actually works. If you have a pension, or you are counting on one, or someone in your family does, you need to see all 4 of these rules today, because missing even one of them can cost you tens of thousands of dollars over the course of your retirement. So before we go any further, hit that subscribe button right now, because later in this video I am going to show you exactly how a married couple can legally take advantage of being married to lower their lifetime tax bill by tens of thousands of dollars, and you do not want to miss that part. And stick around until the end, because Rule 4 involves a true story about a real couple that shows exactly why this entire topic matters so much. And it is the kind of story that changes how you think about your own paperwork forever. Alright, let's get into rule number 1. Rule number 1. Understand your formula, because most pension holders have no idea how their own number is actually calculated. A traditional pension, officially called a defined benefit plan, is not based on how the stock market performs. It is based on a formula, and that formula almost always looks like this. Your years of service multiplied by a multiplier your employer sets, multiplied by your final average salary. Let's make that real. Imagine someone named Richard Malone. Richard worked for the same company for 30 years. His plan gave him a multiplier of 2%, and his final average salary based on his highest earning years was $80,000 a year. So the math looks like this. 30 years times 2% times $80,000. That equals $48,000 a year guaranteed for the rest of Richard's life. That is the power of a defined benefit plan. It does not care what the S&P 500 did last year. It does not care if there is a recession. $48,000 every single year like clockwork. Now here is where I need you to lean in, because this is the part almost nobody explains correctly. Some employers today are shifting away from traditional pensions towards something called a cash balance plan, which is technically still a defined benefit plan, but it behaves more like a hybrid between a pension and a 401k, with a guaranteed growth rate and a stated account balance instead of a monthly formula. A cash balance plan might show you a stated balance, say $300,000, that grows by a guaranteed interest credit every year. And at retirement, you can often choose to take that as a lump sum or convert it into a monthly payment for life. If you're not sure which one you actually have, that is your homework after this video, because the rules around each one can be surprisingly different. But here is the real trap, the one that quietly destroys the value of Richard's $48,000 over time. Inflation. Some pensions include what is called an inflation enhancer, sometimes called a cost of living adjustment, which increases your payment over time to try to keep up with rising prices. But a huge number of private pensions do not include this feature at all. They are fixed. frozen, the exact same dollar amount year after year for the next 20 or 30 years of Richard's retirement. Think about what that actually means. If inflation runs at just 3% to 5% a year, which is not unusual at all, that $48,000 might feel like plenty today, but by the time Richard is 85 years old, it could feel like a fraction of that in real purchasing power. The check stays the same. The number on the paper never changes. But what that number can actually buy shrinks every single year, quietly, invisibly, until one day Richard is standing in a grocery store wondering why the check that used to feel like more than enough suddenly does not stretch nearly as far. There is a psychological trap hiding inside all of this too, something behavioral researchers call fixed income security bias. It is the tendency to feel so safe because of a guaranteed check that you stop paying attention to the risks quietly eating away at it from the inside. Inflation is the perfect example. And here's the flip side worth giving credit for. That same guaranteed pension check gives you real protection against something called sequence of returns risk, the danger of being forced to sell your investments at a loss in the early years of retirement just to cover your bills. Because your pension covers a chunk of your guaranteed baseline expenses, you have more flexibility to leave your 401k and IRA invested through a market downturn instead of being forced to sell at the worst possible moment. A dangerous stretch often called the pension red zone, the first 5 to 10 years of retirement, when a bad sequence of returns can do permanent damage to a portfolio that never fully recovers. Your pension is genuinely protecting you there. But that protection comes with a cost, and understanding your specific pension's inflation protection, or the lack of it, is the foundation everything else in this video is built on. And the formula in inflation is only rule number 1. Rule number 2 is the one that shatters the single biggest myth in all of retirement planning, a myth that has convinced millions of Americans to make a devastating mistake with their pre-tax savings. Let's talk about it. For decades, financial advisors have repeated one phrase so many times that most people simply accept it as fact. You will be in a lower tax bracket in retirement. It sounds logical. You are not working anymore, so your income drops, so your taxes drop too, right? For the 76% of Americans without a pension, that might sometimes be true. But if you have a pension, this assumption can be dangerously wrong, and believing it can cost you thousands of dollars a year without you ever understanding why. Here is the reality nobody explains clearly enough. In retirement, you are not living off one income source. You are often combining 3 at the exact same time: your pension, which is fully taxable as ordinary income, your Social Security, which can also become taxable depending on your total income, and withdrawals from pre-tax retirement accounts like a traditional 401k or IRA, which are also taxed as ordinary income. When you stack all 3 of these together, they do not shrink your tax bracket. They can push you right back into the exact same bracket you were in while you were working, or in some cases, into a bracket that is actually higher. Picture a retired couple with a $48,000 pension, $40,000 in combined Social Security benefits, and $20,000 pulled from a traditional IRA in a single year. That is $108,000 of income, almost all of it taxed as ordinary income. That is not a low tax bracket. For many couples, that lands solidly in the 22% federal bracket, the same bracket or higher than they were in during their working years. Let's talk about how Social Security taxation actually works, because this is where most people get completely blindsided. The IRS uses something called provisional income to decide how much of your Social Security check actually gets taxed. Provisional income takes your other income, including your pension, adds half of your Social Security benefit, and compares that total to a threshold. Cross that threshold, and suddenly up to 85% of your Social Security benefit becomes taxable. 85%. Most retirees have absolutely no idea this threshold even exists until their pension pushes them straight over it. And here's the uncomfortable question almost nobody asks early enough. If your pension alone is already close to that threshold, what happens the year your required minimum distributions kick in too? We are getting there. This is why I always tell people you have to see the forest through the trees. It is easy to look at your pension check in isolation and think, this is a modest amount, surely I am fine. But your pension does not exist in isolation. It combines with Social Security, it combines with your retirement account withdrawals, and together they paint a completely different tax picture than any single piece would ever suggest on its own. There is one small relief valve worth knowing about here. If you are 65 or older, the IRS gives you an additional senior bonus deduction on top of the standard deduction, which can soften the blow slightly. But a small deduction rarely undoes the damage of 3 stacked income sources, pushing you into a higher bracket. A pension is a powerful asset, but the decisions you make around it can impact you for decades. And understanding how it interacts with everything else you own is not optional, it is essential. So pensions do not guarantee a lower bracket. In fact, for many people, they guarantee the opposite. But rule number 2 was just the appetizer. Rule number 3 is where things get genuinely dangerous, because this is the one where the IRS does not ask for your permission. It simply forces your hand, whether you are ready or not. Here is something the financial media almost never explains clearly to pension holders. If you also have money sitting in a traditional 401k or a traditional IRA, the government does not let you decide when to take that money out forever. Once you reach age 73 or age 75, depending on your birth year under current law, you are required to start withdrawing a minimum amount every single year, whether you need the money or not. This is called a required minimum distribution, or RMD, and it does not care that you already have a pension covering your bills. It does not care that you would rather leave that money invested. The IRS forces the withdrawal, and that withdrawal is taxed as ordinary income, stacked directly on top of your pension and your Social Security. Here is how the math actually works using the IRS Uniform Lifetime Table. Let's say you have $500,000 sitting in a traditional IRA when you turn 73. The IRS looks at your life expectancy factor for that age, which under the table is 26.5. You take your account balance, $500,000, and divide it by 26.5. That equals $18,868. That is the minimum amount you are forced to withdraw and pay tax on that year, regardless of whether the market is up or down, regardless of whether you need a single dollar of it. And that number grows the following year because the IRS recalculates your factor as you get older. Now stack that $18,868 on top of Richard's $48,000 pension, and on top of a Social Security check that may now be partially taxable because of provisional income. Suddenly, you can see exactly how a retiree who feels financially comfortable can get pushed into a tax bracket that genuinely shocks them, sometimes even triggering something called the net investment income tax, an additional 3.8% tax that kicks in once your income crosses $200,000 for a single filer, or $250,000 for a married couple filing jointly. And if that combined income also pushes you past certain Medicare thresholds, you can trigger IRMAA surcharges, extra amounts added directly onto your Medicare Part B and Part D premiums, sometimes hundreds of dollars more per month per person for an entire year based on income reported 2 years earlier. So what can you actually do about this? This is where I want you to remember one phrase: Roth conversion. A Roth conversion means intentionally moving money from your traditional pre-tax IRA into a Roth IRA before your RMDs even begin, paying the tax on that conversion now, often during the years between retirement and age 73, when your income might genuinely be lower than it will be later. Once that money is inside a Roth account, it grows tax-free and it is never subject to RMDs again. Done strategically over several years in smaller controlled chunks, a Roth conversion strategy can dramatically shrink the size of the RMD collision you are about to walk directly into. This single decision, timed correctly, can be worth tens of thousands of dollars over the course of your retirement. This is not a decision to make casually. It deserves real planning with real numbers. But ignoring it entirely is exactly how pension holders end up blindsided in their mid-70s. We have covered the formula, the tax reality, and the RMD collision. But rule number 4 is the one that catches married couples the most off guard of all, because it is not really about you. It is about what happens to the person you love most after you are gone. And I need you to pay very close attention to this next part, because I have personally seen this exact mistake devastate surviving spouses financially, and it almost always could have been avoided. When you first start collecting your pension, you are usually given a choice, and this choice is permanent. You cannot change your mind 5 years later. The first option is called single life. This pays you the highest possible monthly check, but the moment you pass away, the payments stop completely, even if your spouse is still alive and still needs that income to live on. The second option is called joint and survivor. This pays you a smaller monthly check while you are alive, but when you pass away, your spouse continues receiving a portion of that payment, often 50%, 75%, or 100%, depending on what you originally selected, for the rest of their life. The third option, less common, is called period certain, which guarantees payments for a specific number of years, say 10 or 20, even if you pass away before that period ends, though it usually pays less than a straight single life option would. Let me tell you about a couple I want you to picture clearly: Mark and Ellen Sullivan. Mark spent 30 years at his company and retired with a solid, dependable pension. When it came time to choose his payout option, Mark looked at the numbers and picked single life, because it paid him and Ellen the most money every single month while they were both alive, and honestly, who does not want the bigger check? They enjoyed a comfortable decade of retirement together, traveling, spending time with grandchildren, living well within their guaranteed income. Then Mark passed away. And this is where the widow's penalty hits quietly, brutally, and almost always by complete surprise. First, Mark's pension check stopped completely because he had chosen single life, that income gone overnight. Second, Ellen lost the smaller of their two Social Security checks because when a spouse passes away, the surviving spouse keeps only the higher of the two benefits, not both combined. So Ellen is already down two income sources at once. But here is the part almost nobody warns you about, the part that makes this a genuine double whammy. Ellen's tax filing status changed too. She went from filing as married, filing jointly, with wide, forgiving tax brackets, to filing as a single individual, with tax bracket thresholds that are roughly half as wide. That means the exact same dollar amount of remaining income, her portion of any remaining pension, her required minimum distributions, can now push her into a noticeably higher tax bracket than she and Mark ever paid together as a married couple. Less income and yet potentially a higher percentage of that income going straight to the IRS. That is the widow's penalty, and it is one of the most under-discussed risks in all of pension planning. This is exactly why this decision can never be made by only looking at which option pays the biggest check today. If Mark and Ellen had chosen the joint and survivor option instead, Mark's monthly check while he was alive would have been smaller, but Ellen would have continued receiving a meaningful portion of that pension for the rest of her own life, cushioning the blow of losing his Social Security check and softening the transition into that harsher single tax bracket. There is no universally right answer here. It depends on your health, your spouse's health, your other assets, and how much guaranteed income your surviving spouse would actually need to maintain their life without you. But I want you to remember this phrase because I say it often. Take advantage of being married to optimize your taxes while you both are alive and while you are still making this choice, because once you sign that pension election form, in almost every single case you cannot go back and change it later. So let's bring this all together. 4 rules the financial media almost never covers, because most of it is written for the 76% of Americans who do not have this specific problem to begin with. Rule 1, know your formula, years of service, times your multiplier, times your final average salary, and find out whether your pension actually has real inflation protection, because a fixed check quietly loses purchasing power every single year it stays frozen. Rule 2, do not assume retirement automatically means a lower tax bracket, because your pension, your Social Security, and your pre-tax withdrawals stack together as ordinary income, and that stack can land you in the same bracket or a higher one than you were ever in while working. Rule 3, prepare now for the required minimum distribution collision waiting for you at age 73 or 75, because the IRS will force that money out whether you need it or not. And a well-timed Roth conversion strategy, started early, can dramatically soften that blow. And Rule 4, choose your pension payout option with your spouse's entire financial future in mind, not just the biggest check available today, because the widow's penalty is real, and it can quietly cut your surviving spouse's income while simultaneously pushing them into a harsher tax bracket at the exact same time. A pension is a powerful asset, one that 76% of working Americans would trade almost anything to have. But as you have seen throughout this video, the decisions you make around that pension, the payout option you choose, the way you coordinate it with Social Security, the way you handle your other retirement accounts can impact you and the people you love for decades. You cannot just look at the size of the check. You have to see the forest through the trees. If this video helped you understand your own pension a little differently, do me a favor and hit that subscribe button, because next time on David Marshall Finance, we're going deeper into something I only touched on today. A strategy some planners quietly call pension arbitrage, using your guaranteed pension income strategically to control exactly when and how you claim Social Security, potentially unlocking tens of thousands of additional dollars over your lifetime. You do not want to miss that one. Until then, take a real look at your own pension paperwork this week. Find out if you actually have an inflation enhancer. Find out which payout option you truly selected. And if you are married, sit down with your spouse and talk about this together, because this is one part of your financial life where waiting until later is the single most expensive mistake you can make. I am David Marshall. This has been David Marshall Finance, and I will see you in the next one.